I'm about to reveal the financial mistakes that have destroyed thousands of retirements. These aren't small errors. These are catastrophic blunders that can leave you broke, desperate, and dependent on others when you should be enjoying your golden years. What if I told you that most people make at least 3 of these mistakes without even realizing it? By the time they discover the damage, it's often too late to fix. The scary part is that these mistakes seem harmless at first. They're easy to make and even easier to ignore. But here's the truth. Every single day you wait to address these issues costs you money. Real money that you'll desperately need later. So if you're planning for retirement or already retired, pay close attention to what I'm about to share. This could be the difference between a comfortable retirement and financial disaster. Let's start with the biggest mistake of all. Underestimating how long you'll actually live. This sounds simple, but it's destroying retirements across the country. People plan for 20 years of retirement when they might need 30 or even 40 years of income. Think about it this way. If you retire at 65 and live to 95, that's 30 years without a paycheck. 30 years of inflation eating away at your purchasing power. 30 years of unexpected expenses and medical bills. Most people simply don't save enough to cover this reality. The average person planning for retirement assumes they'll live to around 80. But medical advances are extending lifespans dramatically. What happens when your money runs out at 82 but you live to 90? You become dependent on family, government assistance, or worse. This isn't a theoretical problem. It's happening to millions of retirees right now. Here's what you need to do instead. Plan for at least 35 years of retirement. Yes, that seems excessive. But it's better to have money left over than to run out. Calculate your expenses for 3.5 decades, not just 2. Factor in inflation at 3 to 4% annually. This is the foundation of retirement planning that most people completely miss. Now let's talk about the second massive mistake. Claiming Social Security too early. This decision alone can cost you hundreds of thousands of dollars over your lifetime. Yet millions of people make this mistake every single year. Here's how it works. You can start claiming Social Security as early as 62. But if you wait until your full retirement age, which is around 67 for most people, your monthly benefit increases significantly. Wait until 70, and it increases even more. We're talking about a difference of 30 to 40% in monthly income. Let me put this in real numbers. Say your full retirement benefit at 67 is $2,000 per month. If you claim at 62, you might only get $1,400. That's $600 less every single month for the rest of your life. Over 30 years, that's more than $200,000 you're leaving on the table. But people claim early anyway. Why? Because they're worried Social Security will run out. Or they need the money right now. Or they simply don't understand the mathematics. The reality is that unless you have serious health issues or desperately need the income, claiming early is almost always a mistake. The optimal strategy for most people is to delay as long as possible. Use other savings to cover expenses in your early 60s. Let your Social Security benefit grow. Then claim the maximum amount at 70. This gives you the highest possible guaranteed income for life. It's like buying an insurance policy against running out of money in your 80s and 90s. The third critical mistake is carrying debt into retirement. This is absolutely devastating to your financial security. Yet more and more people are retiring with mortgages, car loans, and credit card debt still hanging over their heads. Think about what debt does to your retirement budget. Every dollar you pay in interest is a dollar you can't spend on living expenses. Every monthly payment reduces the income available for food, healthcare, and enjoying your retirement. Debt turns retirement from a time of freedom into a time of financial stress. Mortgage debt is particularly dangerous. Many people assume they'll have their house paid off by retirement. But then they refinance to take advantage of lower rates. Or they take out home equity loans for renovations. Suddenly they're 65 years old with 15 years left on their mortgage. Here's the problem with that scenario. Your income drops dramatically in retirement. But your mortgage payment stays exactly the same. What was affordable on a working salary becomes a crushing burden on a fixed income. Many retirees are forced to sell their homes or drastically cut their lifestyle just to make the mortgage payment. Credit card debt is even worse because of the interest rates. Carrying a balance at 18 or 20% interest in retirement is financial suicide. You're paying huge amounts of money for purchases you made years ago. This debt can spiral out of control quickly when you're living on a fixed income. The solution is simple but requires discipline. Make debt elimination a priority before retirement. Pay off your mortgage if at all possible. Get rid of car loans and credit cards completely. Enter retirement with zero debt and suddenly your fixed income goes much further. You have flexibility and freedom instead of stress and obligation. Mistake number 4 is not accounting for healthcare costs. This is where many retirement plans completely fall apart. Healthcare in retirement is expensive. Shockingly expensive. And it keeps getting more expensive every single year. Medicare doesn't cover everything. There are premiums, deductibles, and copays. Many medications aren't fully covered. Dental and vision care usually aren't covered at all. Long-term care, which most people will need eventually, can cost thousands of dollars per month. A couple retiring today needs to plan for at least $300,000 in healthcare costs over their retirement. Let that number sink in. $300,000 just for healthcare. That's on top of all your other living expenses. Most people have no idea this is coming. They assume Medicare will take care of everything. Then they get hit with bills they can't afford. The smart approach is to max out health savings accounts while you're still working. These accounts offer triple tax benefits and can be used for healthcare costs in retirement. Also, consider long-term care insurance in your 50s or early 60s. It's much cheaper than then if you wait until you actually need it. Mistake number 5 is withdrawing too much too soon. This is called sequence of returns risk, and it can destroy your retirement savings faster than almost anything else. Here's how it works. If you retire and immediately start taking large withdrawals, and the market happens to drop in those first few years, you can permanently damage your portfolio. Why? Because you're selling investments when they're down to fund your lifestyle. Those investments never recover because you've already sold them. This creates a downward spiral where your portfolio shrinks faster than it should. Many retirees run out of money in their 70s because they withdrew too aggressively in their 60s. The standard advice is to withdraw 4% of your portfolio annually. But even this can be too much if you're unlucky with market timing. A better approach is to be flexible with withdrawals. Take less in down years. Take more in up years. Have a cash buffer to avoid selling investments during market crashes. Another critical mistake is ignoring inflation. This silent wealth killer erodes your purchasing power every single year. What costs $100 today will cost $130 in 10 years at 3% inflation. Over 30 years of retirement, prices more than double. Most retirees make the mistake of setting a fixed budget and sticking to it. But your expenses don't stay fixed. Everything gets more expensive. Your grocery bill goes up. Your insurance premiums increase. Your property taxes rise. If your income doesn't keep pace, you're getting poorer every year even though you're not spending more. The solution is to build inflation protection into your retirement plan. Keep a portion of your portfolio in stocks even after retirement. They provide growth that can offset inflation. Consider Treasury inflation-protected securities. Delay Social Security to get the maximum benefit with cost of living adjustments. Plan for your expenses to increase 3 to 4% annually. Mistake number 7 is not having a backup plan. Life doesn't go according to plan. Markets crash. Health issues arise. Family emergencies happen. Roofs need replacing. Cars break down. If you've planned for everything to go perfectly, you're setting yourself up for disaster. Smart retirees have contingency plans. They keep extra cash reserves. They have insurance for major risks. They know what expenses they could cut if necessary. They've thought through scenarios like what happens if one spouse dies early or needs expensive care. This kind of planning isn't pessimistic. It's realistic. The retirees who weather storms best are the ones who anticipated them. They're not caught off guard when something goes wrong. They have options and flexibility built into their financial plan. Another massive mistake is helping adult children financially during retirement. This sounds harsh, but it's true. Many retirees sabotage their own financial security by giving money to kids or grandkids. They help with down payments. They pay for weddings. They cover emergencies. They can't say no. Here's the brutal reality. Your kids have decades to recover financially. You don't. Every dollar you give away in retirement is a dollar you can't get back. There are no do-overs. If you run out of money at 80, you can't go back to work and rebuild your savings. This doesn't mean you can't help your family at all. But it means setting clear boundaries. Don't sacrifice your financial security for anyone else. Make sure your own retirement is fully funded before giving money away. Your kids will understand, and if they don't, that's their problem, not yours. The final critical mistake is not adjusting your investment strategy as you age. What worked in your 40s and 50s won't work in your 70s and 80s. Your risk tolerance should decrease as you get older. You have less time to recover from market downturns. Many retirees make the mistake of staying too aggressive with investments. They keep 70 or 80% in stocks well into their 70s. Then a market crash hits and they panic. They sell at the bottom and lock in massive losses. Their retirement is permanently damaged. Others make the opposite mistake. They become too conservative too quickly. They move everything to cash and bonds in their 60s. Then inflation destroys their purchasing power over the next 30 years. They run out of money because their investments didn't grow enough. The right approach is a gradual shift toward more conservative investments as you age. In your 60s, maybe 60% stocks and 40% bonds. In your 70s, 50-50. In your 80s, 40% stocks and 60% bonds. This provides growth potential while limiting downside risk. Let me wrap this up with the most important point of all. The biggest mistake is not taking action right now. Every day you delay addressing these issues makes them harder to fix. If you're making any of these mistakes, start correcting them today. Not next month. Not next year. Today. Review your retirement plan. Calculate how long your money will actually last. Consider delaying Social Security. Eliminate debt aggressively. Build in healthcare costs and inflation. Create contingency plans. Adjust your investment strategy. Set boundaries with family members. These steps aren't complicated, but they require discipline and honest assessment. Most people avoid this work because it's uncomfortable. They don't want to face the reality of their situation. But avoiding reality doesn't change reality. It just makes the eventual consequences worse. Your retirement security depends on the decisions you make right now. Not the decisions you wish you'd made in the past. Not the decisions you'll make someday in the future. The decisions you make today. So take action. Your future self will thank you for it.